In this video, we'll be looking at Goodwill. We'll look at what it is and how to calculate it, and we'll go over an example to see how it affects work paper entries. Goodwill is covered in FASB Codification 350-20 and is defined as an asset representing the future economic benefits arising from other assets acquired in a business combination that are not individually identified and separately recognized. So, when Company P acquires Company S and the value implied by the purchase price is more than the fair value of a subsidiary's net assets, goodwill is recognized. The parent company might be willing to pay this premium because they want to make sure the deal gets closed, or they believe the synergies generated by the combination will be more than the price paid for the subsidiary. A simple example of a combination resulting in the recognition of goodwill is if a coffee company were to buy 100% of a local coffee shop. If they paid $30,000 and the fair value of the local coffee shop's net assets was $25,000, then $5,000 of goodwill is recognized. This problem says that on January 1st, 2010, Pam Company purchased an 85% interest in Shaw Company for $540,000. From this information, we'll be able to calculate the implied value of Shaw Company. Then the problem says that on this date, Shaw Company had common stock of $400,000 and retained earnings of $140,000. These numbers will help us determine the difference between the implied and book value. The problem then says that only the marketable securities and equipment had book values not equal to their fair value, and we can see that marketable securities were undervalued by $25,000 and equipment was overvalued by $20,000. We'll be able to use these numbers to determine goodwill. To solve this problem, we'll first look at a computation and allocation schedule. We can start off by adding the purchase price of $540,000, and from this we can determine the implied value by dividing $540,000 by 85%. And we can then calculate the non-controlling interest by multiplying the implied value by 15%. We were also given the common stock and retained earnings of Shaw Company, and if we subtract the total book value from the implied value, we get a difference of $95,294. We also know that marketable securities were undervalued by $25,000 and equipment was overvalued by $20,000, so we can enter those numbers. The sum of these three numbers gives you the goodwill. Now we can use these numbers to make our work paper entries. First, we'll want to eliminate the investment account. We'll do that by crediting investment in S and non-controlling interest for the red and green amounts found in the schedule. Then we can debit common stock and retained earnings using the blue and purple numbers, and the difference found in orange is also debited. The second entry is to distribute the difference between implied and book value. For this entry, we credit difference between implied and book value to eliminate it. Marketable securities were undervalued, so we bring them up to fair value by debiting them for $25,000, and equipment was overvalued, so we bring it down to fair value by crediting it for $20,000. Since the problem stated that these were the only assets not equal to fair value, the rest of the difference is allocated to goodwill. The last entry for the year of acquisition debits equipment and credits depreciation expense. This entry amortizes the $200,000 overvaluation of equipment for the first of 5 years. These are the three work paper entries made in the year of acquisition. First, we eliminated the investment account. Then, we distributed the difference between implied and book value, which included recognizing goodwill since the implied value of Shaw Company was greater than the fair value of its net assets. And lastly, we amortized the overvaluation of equipment.